The wild ride of global renewable energy prices. Solar dives while wind climbs. Picture this. In a world racing toward cleaner energy, the prices for solar power are dropping like a stone, while those for wind energy are soaring higher and higher. It's a dramatic shift that's reshaping how we think about powering our planet sustainably, and it all boils down to changing costs, interest rates, and market dynamics. But here's where it gets controversial. Is this disparity setting solar up for unstoppable dominance, or is it unfairly penalizing wind's reliability? Stick around as we dive into the details, uncovering why these trends matter for the future of green energy. A seismic shift in equipment costs and pricing. Over the past few years, Global Power Purchase Agreement, PPA, prices for solar photovoltaic, PV, and onshore wind projects have undergone a massive transformation. PPAs, for those new to the term, are long-term contracts where buyers agree to purchase electricity from renewable projects at set prices, providing stability for both developers and investors. On the cost front, the break-even prices, essentially the minimum price needed for a project to break even, have followed starkly different paths. Solar PV costs have been on a steady decline, while onshore wind costs have risen sharply. Looking ahead, Rystad Energy predicts that solar costs will stabilize within a narrow range over the next 5 years, whereas wind costs are poised to climb even higher, with more variability from region to region. And this is the part most people miss. Costs aren't the whole story. Wind projects often command better capture prices in the market, which can make them economically appealing despite steeper upfront expenses. Overall, Rystad's analysis shows that fair value PPA prices for solar PV tend to be lower than those for onshore wind on a global scale, though significant regional differences abound, creating a fascinating puzzle for investors and policymakers alike. Why wind faces higher Capex challenges than solar? PPA prices hinge on two main pillars: the project's costs and the prevailing power market prices at its location. Both solar PV and onshore wind are capital-intensive ventures, meaning their success depends heavily on initial investments rather than ongoing operating expenses. Capital expenditure, Capex, the money spent on building out the project, is the big driver here, paired with the capacity factor, how much electricity the project generates relative to its potential, and the offtake price, the revenue from selling power. Solar projects have seen their Capex intensity plummet thanks to technological leaps and booming manufacturing scales. Back in 2010, the global average was over $5 per watt. Today, it's expected to hover around 80 cents per watt. China's dominance in producing solar components, accounting for more than 90% of global capacity for ingots, wafers, cells, and modules, means most projects worldwide use Chinese parts, keeping costs consistent. This results in a tight spread of Capex intensity globally, with upper and lower quartiles rarely deviating more than 10% from the median. By 2025, expect it to range from 80 cents to $1 per watt, staying stable for the foreseeable future. Markets like China, India, the UAE, and Saudi Arabia boast averages below the lowest quartile, while the US and Japan sit higher, offering a real-world example of how local factors, like supply chains and labor costs, can influence affordability. Wind, on the other hand, has grappled with rising Capex intensity. Inflation and climbing interest rates hit manufacturers hard between 2020 and 2023, pushing the global average from $1.14 per watt to $1.59 per watt. Costs have since steadied, and they're likely to hold at this elevated level through 2030. Wind's manufacturing is more spread out than solar's, leading to wider global variations based on component origins and project sites. Western original equipment manufacturers, OEMs, face higher costs than their Chinese rivals, so projects in Western nations often come with bigger price tags than those in Asia. The median Capex for onshore wind has crept above $1.50 per watt lately and should stay there, but the upper quartile could exceed $2 per watt, widening the gap to over 30% by 2030. China again stands out as an outlier with lower costs, while Australia and the US are on the high end. This disparity sparks debate. Are Western markets at a disadvantage due to higher costs, or does it reflect necessary investments for innovation? How capital costs and resource availability drive break-even prices. Diving deeper, Rystad Energy's examination of 35 markets reveals that break-even prices are sensitive to several variables: Capex, operating expenses, OPEX, discount rates, essentially the cost of borrowing money, and capacity factors. Both solar and wind projects are especially vulnerable to discount rate changes, as renewable energy is highly capital dependent. In regions with pricey capital, like many developing countries, these projects struggle, particularly if solar or wind resources aren't abundant. Capacity factors, which measure actual output, vary widely and cause break-even prices to swing. For solar PV, they might range from $6 to $8 per megawatt-hour, MWH, while onshore wind sits between $9 and $11 per megawatt-hour, based on 15% deviations from base cases. This underscores the capital-heavy nature of renewables. A slight dip in output or rise in financing costs can turn a viable project into a challenge. Market comparisons show this hits wind harder than solar in diverse locations, raising questions about fairness in global energy transitions. Interestingly, OPEX plays a minor role since neither solar nor wind needs fuel. They rely on free resources like sunlight and wind. Solar, in particular, sees little impact from OPEX changes on overall economics, simplifying the equation somewhat. Wind's edge in market capture rates. Beyond costs, PPA pricing depends on capture prices, the actual earnings from selling power into the spot market. These vary by region due to differences in generation mixes, grids, and demand. For instance, California's CAISO has among the lowest wholesale prices, while Australia's New South Wales and Western Australia are at the higher end. Capture rates represent the average price earned as a percentage of market prices. We calculate them by analyzing how much solar or wind contributes to generation and their resulting rates. Wind generally enjoys higher capture rates because its output is more spread out, avoiding the cannibalization effect seen in solar, where concentrated daytime production drives down prices through excess supply. Batteries are growing, but not fast enough to fully counteract solar's midday surges. In places like New South Wales, solar capture prices have dipped to about 40%. Many high solar regions worldwide hover between 40 to 60%, or are heading there soon. Wind, meanwhile, rarely drops below 80%, and projections keep it above 70%. So, even if solar's break-even prices are lower and make it seem cheaper, its spot market earnings can be far weaker, ultimately influencing PPA deals. Solar generally reigns supreme in PPA pricing globally. Across the 35 markets studied, with projects starting in 2025, solar PV PPAs average lower than onshore winds. The absolute low. Saudi Arabia's solar low case at just $16.30 per megawatt-hour. Middle Eastern nations, plus India, China, CAISO, Morocco, and Spain, all hit solar lows under $25 per megawatt-hour, thanks to low costs, strong capacity factors, or both. The UAE and Saudi Arabia shine as top performers, blending rock-bottom expenses with ideal conditions. At the other end, most high-priced deals come from onshore wind high cases, think Malaysia, Queensland, Australia, Germany, and Italy, where elevated costs, weaker capacity factors, and high discount rates inflate prices. This landscape begs a provocative question. With solar's cost advantages and wind's market strengths, are we witnessing the beginning of a solar-dominated era, or will wind's consistency make it indispensable? What if policies in Western countries, burdened by higher costs, inadvertently favor Asian manufacturers? It's a debate worth having. By Rystad Energy, https://www.rystadenergy.com. More top reads from oilprice.com. Kazakh oil field cuts production after Russian gas plant drone attack. https://oil.piriki.com. Latest energy news. World news. Kazakh oil field cuts production after Russian gas plant drone attack. HTML. China unveils world's largest wind turbine. https://oilprice.com/latest energy news /world news /China unveils world's largest wind turbine. HTML. Waymo's UK launch sparks debate on autonomous vehicle laws. https://oilprice.com/energy/energy-general /Waymo's UK launch sparks debate on autonomous vehicle laws. HTML. What do you think? Will solar's falling prices lead to a greener, more affordable future, or is wind's resilience the key to balancing our